Hey, what's up guys? In this video, we're going to talk about derivatives, specifically futures trading, because it's one of the most popular, margin trading is one of the most popular forms of trading in all markets, whether it's Forex or cryptocurrency. And for daily traders like myself, if you sit down every day and trade the markets, basically this is what you trade with most of the time, because like I explained on the last video when I was talking about spot trading isn't as volatile as futures trading, because in most cases, spot trading is buy low, sell high. It can only be traded one direction when the market is going up, right? So you always want the market to go up. Whereas derivatives makes you money whether you're going down or you're going up, but there's also leverage and stuff like that. So I will explain this in detail in this video. But first of all, let's look at what a derivative is. I'm looking at Investopedia here. They say, what is a derivative? A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, a benchmark. The derivative itself is a contract between two or more parties, and the derivative derives its price from fluctuations in the underlying asset. Okay, the most common underlying asset for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. These are assets that are commonly purchased through brokerages. Okay, so this is a technical explanation somehow, or at least a formal explanation of what these things are. But to be honest, it's really gambling at its best. That's what derivatives are, especially futures or margin trading, because what this means is that you're saying that we're not going to be trading Bitcoin, but what we're going to do is we're going to create a contract and trade it according to what happens, based on what happens to the Bitcoin price, right? Meaning that, if one Bitcoin is $10,000, that contract will be sold at $10,000, right? And the difference though, because these are simply contract, not the assets themselves, they can be traded in both directions, going up, going down, because you're making bets. They're futures, meaning that you can say that, hey, I think the market is going to go up, or I think the market is going to go down, and you take position based on that. If you're right, the market goes in your, if the market is going in your direction, you make money. Another feature to this is the implementation of leverage, especially with futures trading. Futures trading is derivatives, obviously, which gives you sort of you're betting on the future price of Bitcoin or Litecoin or OMG, whatever contract that you're trading on a particular exchange. A good example of this is, you remember there's a guy who made in The Big Short, the guy who said he shorted the housing market, right? Because the housing market was going bullish for some years and a lot of things didn't make sense because of the subprime loans and stuff like that on Wall Street. He saw that was a risk. So because it's Wall Street, it has a lot of financial instruments. There are instruments that allow him to bet against a certain market, right? It means that there should be someone else who is willing to bet, like, I think the market is going to continue going up, and he betted that, no, I think the market will go down, right? And he ended up to be right, and he made a whole lot of money doing that. So let's look into what a futures look like. I'm going to go on Binance right now, but you can do this on any exchange. If you're in the United States, by the way, futures on Binance do not work for you, so you need to use what is the other platform again? You guys in the States, you need to use, is it OKCoin? No, not OKCoin. What is it again? Let me find it. I'm sorry. I don't know why I'm forgetting this. It's ridiculous. Yeah, Cumex, KuCoin. You guys need to use KuCoin. It's an exchange, and it also has Cumex, which is it's a future, it's a derivative market of KuCoin. It's called CUMEX. So the link is in the description as well, in the course material. That's where you can trade futures if you're American. But the fundamentals are the same, so don't worry about the exchange. I will do another tutorial as well showing you how these things work on CUMEX or KuCoin. I've used it once. So in this instance, right, these are futures. If I go here, I have different types of futures of BTC, USDT, Ethereum, USDT, BCH. So meaning that there are futures for a lot of coins here on Binance, right? Now, one contract is being sold at 8,889. This is the spot Bitcoin price. You're trading futures, but again, they're based on the Bitcoin price. So, you know, what you're doing here is that you're saying that, okay, Bitcoin is at 8,889 right now. I think it will go to 10,000, right? If you're saying that, that's your position, you're gonna go long. If you're betting on the market going bullish or going up, we call it long, right? And if you end up to be right and this number keeps increasing and reach 10,000 as you betted it, you actually make money, right? And you also have sell shorts. If I'm saying I think the price of Bitcoin is going down to 8,000 from here, then you go short and you put the amount of BTC you want to bet on, and you make money. And again, you can do this with all different coins that are here. Now, Binance futures do not work in the United States, but if you're in the United States, you can use CUMEX or KuCoin. Sign up on KuCoin. The link is in the course material. And then they have CUMEX, which is the side of derivatives trading on the KuCoin platform. So you know, it's pretty much the same thing. The UI, the user interface is obviously different, but the principles or the fundamentals are the same, and I'll make a tutorial showing you guys how to do that. So let's have a practical example of what this would look like. Okay, so I made a couple of trades last night before I went to bed, just so that I can have examples to show you guys. But basically, if you look at this is, by the way, you can also use Trading View here. If you look at what happened, there's a coin that I traded here. It's called IOST, I think. Yeah, this one here, right? If you're in my private group, in my group, Crypto Secret Society, it's a public group. I posted of this trade last night, right? This coin went up, I think it was 22% of something, right? And what I did, I went into the group and I told the guys like, hey, this coin has gone, you know, so bullish. It might be a good idea to short it. And then I shorted. When I woke up, I ended up making some good profit off it. So that was kind of interesting. Let me just put this back to 1 minute so that I can be able to show you the trade that I made on it. Yeah, so this was it. This was last night somewhere here, right? And then I shorted up to somewhere around here. I ended up exiting my position when I woke up. So that was a good profit. So what I did, I just baited that, hey, I think the market, this coin, it has gone up too much. I think it has to come all the way down. And it did, right? So that is futures for you. But then let's also look at other features of futures, right? Let's look at leverage, which is a very, very important concept here. But I think I need to rather do this on BTC. So leverage, it's a very, very important topic, right? Spot trading, if you want to trade with one Bitcoin right now, you need to have an amount that equates to one Bitcoin. At this point, it's 8,895. In futures trading, right, there are two things to worry about. You have, number one, you have leverage, right? Leverage means that for $100, you can trade with up to, let me just actually show you instead. I'm gonna just go to 100x leverage. This is highly risky. I'm not saying you should do this. I'm just using it as an example for simple math. Let me actually make it exactly 100x. Okay. Now, if I want to trade with, you see, this is the price of Bitcoin, and let's say I want to trade with one Bitcoin, right? Look at how much do I need. I need $93 to trade with one Bitcoin, right? Meaning that if I have one Bitcoin and the price of Bitcoin changes by $200, I make $200 too. If it goes from like 8890 to 8790, I mean to 8690, it means that I have made $200, because now it's almost like I have 200, but I have only used $90. And I know this is a very difficult concept for people to understand. The more leverage you take, the less money you need to trade. Like here now, I've raised my leverage to 125. Now I need, for me to trade with one Bitcoin, I only need $74. I don't know if you guys can see here, but that is the issue. And you see that if I decrease my leverage position to like 25x, now I need $359 to trade with one Bitcoin. So the more leverage you take, it means the less money you need to trade, but the higher the risk. That's a problem, right? And what do I mean by I say risk? It means this is not spot trading. In spot trading, if the market is going against you, you still don't lose your currency. Whereas if in futures, if you are wrong and the market is going against you, imagine this as a bet. You betted $100 saying that Bitcoin is going to 10,000. If Bitcoin keeps going down, it means that you're slowly losing that $100 that you betted. It's going down $95, $80, $70, $50. The lower the Bitcoin price goes, the lower your money is going to be going as well, right? Because you actually said it's going to 10,000. But it's going the opposite. Or if you say, I think Bitcoin is going to $7,000 or $5,000, and you take a short position, you will be making money if the price of Bitcoin is going down, meaning that the lower it gets, the more money you make. If it keeps going down, the little money that you baited here, it's gonna now be lowering and lowering and lowering and lowering to the point that you're gonna get liquidated. When it's liquidated, it means that you have lost all your money that you baited. So another important concept here, and this is a feature that some exchanges don't have and some of them do have. You see here it says isolated, right? Isolated or cross. So cross, and let me start with isolated, right? Isolated margin. The best way to explain this, let's take a quick position here. So I will take a position of 0.1 Bitcoin. 0.1 Bitcoin. I will take a long position, betting that Bitcoin is going up. And as you can see, it's only going to cost me $35, but that's 0.1. right? And if you don't see any difference there, and we have a position here, you can see it's already activated, right? If you guys don't see a difference, I'm trading as if I have 0.1 Bitcoin, but I've only paid, you can see here, my margin is $35. Let's go to Coinbase and calculate how much, or let's just go to Google, say USD BTC, right? 0.1 Bitcoin, ladies and gentlemen, is 0.1 is $889. For me to have 0.1 Bitcoin, I need to have 889. But because I'm leveraging, I'm only trading with $35, right? Because that's how leveraging works. So if you do the math, like 35, which is what I'm trading with now, times 25, which is the leverage that we have now, it's roughly around 875, as you can see here. So let's go back. Now we have a position, and you see, actually it dipped so much quickly. Actually, the price might be going tremendously down. But anyway, we have lost $4 so far. But I didn't do any technical analysis, so this was just for education purposes. Don't trade like this, okay? And as you can see, futures trading happens in real time, okay? But let me get back to the main story, isolated. So isolated means that if I'm wrong, right, I will only lose maximum $35 that I betted. It's not gonna affect any of the other funds that I have in the wallet. Here, I still have $174. That's for me, right? And if you look here, it says liquid price. This means the liquidation price. Liquidation price means that if the market goes down to 8,571, I will lose all my $35 that I've used to bet on this position, right? Now, if I had taken more margin, like let's say I had gone 50x leverage, it means that I could have gotten liquidated quicker than what I've done here. Getting liquidated at 8,500, maybe I could have been liquidated at 8,700 instead, right? Instead of 8,500. So the more leverage you mean, the faster you get liquidated. The less leverage I use here, it also means that it takes longer for me to liquidate. So if I decrease my position, it means that I have less leverage, but then I have more. I have a longer liquidation sort of price. Meaning that if I had to take in half of this, I could have been getting liquidated at maybe 8,500 and 8,200 or 8,250. You can do the math. So that's what isolated means. And there is another one here called cross. Okay, if I had to be trading on cross, right, I'm only using $35 for my position. On cross, it could have been, say, my liquidation price here could have been way lower than this, meaning that it would take a very long time for me to get liquidated, because if I'm getting close to liquidation, the trading engine takes some of these funds that I have on the side, add them to my trade to make sure that I don't get liquidated. Because sometimes what happens is that, like what happened here, right? You can take a position and this flash drop happens, right? The market just goes up too quickly or go down too quickly, but then it reverses itself and normalized where it was. If you had an isolated position and you had a liquidation price, say here at 8,783, it means that I could have gotten liquidated here, or I could have gotten stopped if I had a stop loss right here, right? But that didn't happen because this is not my liquidation price. But you don't want to get into those positions where flashes like this take you out of the position, because I have taken a long position, but just simply because the market dipped quite quickly here, it means that I will lose money. It might mean that, this happened, but then it still goes to my direction that I want, which is this way. And then I'll end up making money, right? So the cross helps you with this kind of situations. That's why you must always have some money to make sure that you don't get quickly liquidated. So because I'm doing some educational stuff, I'm gonna exit this position right now. I will close the position right now and take another position at cross and show you guys the difference, right? I will take 0.1 again at 25x leverage. Okay, so now we had cross. I will go again 0.1. It's still gonna cost me about $36 now, and I will take a position here, and I'm still going long. Okay, so you can see here it's what is it saying now? I'm gonna only get liquidated at 6,837. Why? Because my position is still only worth 0.1 Bitcoin, but I still have more money in my account here, meaning that it's gonna take a very long time for me to get liquidated. The more money I add into my futures wallet, it means that the lower this number will get. And because remember, this number has to be lower because I'm longing the market, predicting for it to go up. So I'll only get liquidated when it goes against me, which is it starts going down, okay? And that is what cross means. And I recommend, if you're just getting started, to use isolated and not cross, because if you don't know how to trade, you take a position, you become too confident into the position, you go to bed, in the morning you wake up, you've lost all your money, right? Cross is how people lose all their money. And you might be like, so why would someone use cross? Again, I explained it to you. You're trying to protect your position, because sometimes the market might go against you first before it starts going into your direction. So that's why cross is also very important. And another thing actually to pay attention to is to make sure you put your stop losses and stuff like that, especially when you're trading cross. When I'm trading isolated, I don't really worry about much, because if I'm trading with a certain amount, if you're trading with $100 or $1,000, I know that that's all I've betted to lose. I'm not going to lose anything more than that. So this cross and cross, you have to really be extremely careful with it. Be extremely careful. And if you have an isolated position, you can also sometimes change the position itself. Okay, you can increase margin to make sure that you don't get liquidated the fastest. But here it just uses directly the money that you have into your wallet, into your position, and that's what margin is all about, guys. And that's what futures trading is really all about. It's about betting. Is it the market going up, going down? And like I said, going up, you say buy long. Going down, you say sell short. So don't get over leveraged. That's all I can tell you guys. Don't bet more than you can afford to lose, and start very small. The good thing about futures is that you can make a lot of money, but with very little money because you have leverage. But also you can lose the money just as fast. As you can see here, I have a liquidation price. If you're on Binance, it also has a calculator which helps you to calculate your position before you enter the position. But I have all this in my Binance specific tutorial on how Binance works. So just quickly so that you understand, P&L is your profit and loss, and it actually updates in real time. Right now we have made $1.90 in this position, or 5% of our position. And these things happen in real time here when you cross. And also you see that certain numbers changes, like margin ratio, depending on what's happening to your margin here. And just that you guys know, you can actually book me for a one-on-one mentorship program, which lasts for 1 month. And I will be coaching you personally. We can be doing things like this live or together on Zoom. And you can actually learn this kind of things very fast. So if you want that, make sure you go to cryptouniversity.co.za/mentorship, or you will see in the menu tab, there's a mentorship option. Go there and book for a one-on-one. It will go for 1 month, meaning that I'll be training you for 1 month full time, but you pick the time. It's something very flexible depending on how much time you have and what you have to be doing. So if you have a full-time job but you also want to learn trading, it's an excellent way to do it. You book sessions whenever it suits you. And another thing I wanted to share is that cross margin is very helpful when you say taking very big positions that will take time to sort of come to light, right? Say you're betting that Bitcoin is going to $5,000, right? There are people who have those narratives. Wow, Bitcoin is going down to $6,000, right? And you want to take that bet right now. You could, right? But you also must be very aware that before it even starts going down, it could go against you. Bitcoin could go up to 9,000 or 10,000 or 11,000, but you're still convinced that it will go to 5,000 or 6,000, right? So because those kind of trades, take long time to actually fulfill, and those are the biggest money-making trades anyway, to be honest with you. You make money on trades that take time to actually prevail, right? And as a trader, you must always have some of those. So on that kind of bet, you know that the market will go against you, maybe before it even starts going towards your way. You need cross, and you also need to have money in the wallet to make sure that even when it's going against you, you don't get liquidated. You let the market go and chow you for a little bit, and then when things start happening slowly, it starts going towards your direction. Whereas if you're just daily trading, scalping, what we call scalping is like you sit here and let me just show you what I mean. Scalping is that you sit down and you trade the price movement. You use the 1 minute. I personally use the 1 minute scale here. I typically do this on TradingView. Then I just go on BitMEX or Binance and put my position, right? And you're looking at 1 minute scales, and what you're trying to do is to trade these volatilities here, the obvious moves on a daily, right? So these ones, it's very good to do isolated, because you know that you take small bets, maybe with high leverage, but you know that if you are right, you will make some money through it, right? And as you can see, this is only today. There have been only a big move like this, meaning that if you're a day trader, you could probably have traded some of this, right? Whereas if you're a guy who is all about cross, sometimes you might be looking at I like to look at 4 hours. Let me say you might be looking, because everyone is different, have their own way of doing this. But I like to look at 4 hours from 4 hours going up for my longer term trades, right? And what I mean by this, a good example would be at this position. Say you said that BTC, the way it's been moving now, I think it will go down, right? And BTC is here. And you're like, with this sideways movement, I think we're crashing here. And you take a short position. And you take a short position betting that it's going to go down, and it actually continues to go up, right? But again, this does not mean that you're wrong. It just means that, the time of what you predicted maybe hasn't reached yet based on your technical analysis. And you have taken your position, and meaning that on your P&L at this period here, where BTC keeps going up, you're losing money. But look at what happened afterwards. It now went all the way down and crashed up to this point, right? So meaning that if you're taking a short position here, you actually cashed out with a lot of money at this point here, right? But the problem is you actually started with losing money over time before it even crashed up to this point. So this is what happens, especially when you're trading. It's like that is where cross margin comes in to protect you from things like this. Otherwise, if you had isolated, you could have actually lost money by this time, and then you could have watched the market going down. Like, I knew it was gonna go down, but then I got liquidated faster. Like, hey, if you had a cross position with enough funds into it, could have helped you to not get liquidated faster and make dough when it was coming down this way. So I hope I've done a good job of explaining this here, guys, and I hope you guys are gonna go out there and trade for real. Thank you guys for watching, and stay awesome. Let me actually just exit this position here, because I don't really it was just an example. I don't really buy it like that. I need to do technical analysis before I trade, but yeah, it will exit, I'm sure. Thank you guys, and stay awesome.